There we go. Hey, everybody. Jim here. Thanks for joining us tonight. Since everyone's finishing up dinner, again, we're a minute early right now. We usually like to give, 2 to 3 extra minutes for everyone to finish what they're doing, get settled in from work, from dinner, from time with family, so that we can, have a full night tonight. It's going to be a really good one. I've been looking forward to sharing this and showing them the principles, lessons. We've got Jaden on with us tonight. Allison is here, one of our counselor extraordinaires, has been with us a decade. I think Jen's on, a few of the team members are on, and we're actually going to tour the office tonight on this. A lot of you guys have been asking, what about this new office? We're excited. We've been having investors come down and tour, and I'm going to share a little of that tonight. I'm here tonight. I'm one of 2 people left in the office right now. I'm going to show you guys what we're planning on doing in 2025 here. It's pretty exciting. So 7 o'clock now. Let's wait about 2 minutes, guys, and then we're going to get started. And we will be looking forward to a fun learning evening tonight.
Jim, did you see we had someone joining us from Vietnam?
Very cool. Well, welcome aboard. Welcome aboard.
It's 7 a.m. over there.
Wow. And I see Danny's here. Danny, thanks. Oh, that's from Vietnam. Danny, thank you. Wow. Yep, I remember you from Rockstar. Absolutely. Welcome back, Danny. So Danny's an investor of ours coming in from Canada, but now is in Vietnam. Small world, small world. Well, good. We will get started, Danny, and everyone else that's on. I see people are loading through. It's going to be a great night. We're going to go through some history, some principles, do a little tour, go over some properties and what we're seeing for 2025 in real estate. Just in the last 2 days, I know Allison's phone has been ringing off the hook. There's been a lot of changes. To be very clear, I don't really care where you stand politically. I look at things through the real estate lens for our entrepreneurial pursuits. And good things are happening with real estate now. We're going to talk a little bit about that tonight, and also some of the things I think hopefully we can help you with. But whether you decide to come on board or if we're not a right fit, I think you're going to learn some lessons that can be taken into account and used wherever you go if you're going to be a successful real estate investor, especially in today's climate and how to navigate it. So again, 1 more minute, guys, and then we're going to get started. Looking forward to this, and we'll talk to you guys in 1 minute. Let's let a few more people get on, and we'll go from there. Okay, guys, I know again some more people are joining. Appreciate you being here. Let's wait 1 more minute. We'll get started. Again, Allison is going to be manning the chat box with Jaden. She can answer a ton of questions, or if you want to wait till the end, I am going to save time for brainstorming questions, points of clarity that you might need, market news. Happy to do that. So I will do that at the end. But again, Alice can be answering along the way too. So, please don't be shy to ask questions. It's always very helpful for learning. Okay, well, look, a few minutes after 7 now, let's get started. I'm Jim Sheils. A lot of you have met me or know me. I've been a full-time real estate investor now. I'm very disappointed to tell you 26 years, because I used to be a lot younger when I started this, but now oh, I think my mute was on. Is that correct? Sorry about that, guys. Yeah, sorry, I was very quiet. So let me start again. My wife always says I sound better muted. So my name is Jim Sheils. I've worked with a lot of you. I've been a full-time real estate investor for almost 26 years now. And it's been quite a ride. And we're going to talk a little bit about that today and where I've ended up today with Southern Impression Homes and our business mission. So our team, now this is only part of our team at SI Home, which is over 130 team members. We're very excited, and things are growing in a great direction. It was started really with my good friend and partner Chris Funk. Him and his father started this years ago. That's where we teamed up, and I actually merged my company a few years ago to join forces because we had done so many deals together. It seemed like a great fit. This is just those disclaimers we got to have in there, guys, always to say about the presentation, something you always got to include. My journey started 26 years ago, 28 years ago, really, with reading. I knew I wanted to be an entrepreneur. I was looking at tons of different things. I read Rich Dad, Poor Dad, Seven Habits of Highly Effective People, and I kept coming back to something that just made sense to me, and that was real estate. I had read a stat that 8 out of 10 millionaires at that time, this was in the late 90s, made their money in real estate, and I liked those odds. And so after looking at lots of different entrepreneurial business opportunities, lots of different pursuits, I settled on real estate. And I took a real estate course. Now you're talking in 1998. I took a real estate course for $5,000. And everyone thought I was insane. I mean, I tried not to tell family and friends this, but I did. And they're like, you're being robbed. Is this some infomercial scam? What are you doing? But this class really opened up the doors to me becoming a millionaire and multimillionaire. So that learning has always been a key thing that I've tried to continue. And the reason why I went into real estate is I had decided at a young age I wanted to get real estate in place so I get to the important things, the good stuff. And we're going to talk a little bit about that today because it's not really about the real estate, it's what the real estate can provide. And that's passive income with active freedom. We don't want you to have a second or third job with owning real estate. We want you to buy back your time and be with the people you love, doing the things you like. And that's what real estate's been able to do for me. And it all started with this first deal, Lompoc, California, 432 North M Street. I bought this property in 1999 for 152.5. I sold it in 2004 for 570. And before I sold it, I did an interesting refinance to help build a business, and I'll talk about that. Today's value is about 865. So this is a pretty good lesson in being a long-term buy and hold investor. You know, and if you look at this, this was me. I had my slim shady hair. Looks like I ate some extra sandwiches on the job, and I got more paint on me than I did on the walls that day. And I remember my contractor friend saying, "You're not allowed to help anymore." So I've done thousands of rehabs, but I've only actually done 2 of the rehabs myself. So what I learned was it's not about my skill set, it's about the systems and the people that I'm putting around me. And with that timing is timing the market. It's time in the market, not timing the market. Again, I got into it in real estate has its ups and downs, but when you're looking for long-term equity growth, if you're always trying to just time the market, you've been missing that time. And so I found that it's the length of time you're in the market where your odds of success and wealth go up. And I had 2 very close examples in my life of this. So what's the key to wealth for me in real estate? It's long-term buy and hold. It's buying a good piece of real estate and holding it for the long term. That's the most simple, effective formula that most people have created their wealth, including myself. Look at this house. This is my family home that I grew up with in Morristown, New Jersey. My parents bought this in the early 70s for $49,000. Beautiful 1-acre property, very simple home for the area that we were in. My parents didn't come from a lot of money. They never made a lot of money. Proud I was able to retire them, but this was their partial retirement tool because they were able to sell it in the early 2000s, about 30 years later, for just under 600,000. So they averaged an 8% return for that 30 years, and it created any of the wealth that they had. This one goes back even further. You're looking at this house in Cross Keys, Ireland. This was my great-grandfather's house. I imagine that it was built from what I've tried to assess just before the turn of the century for less than $1,000. My second cousin owns this today. And so this is a 142-year-old buy and hold in our family. And what it's taught me, and this is worth a lot more than $800 now from the initial build costs, that if you will hold for the long term and start now, that you can produce a lot. You don't have to go 142 years, although it'd be nice. But to get a few years in and start to feel that wind at your back can be a very exciting event for your real estate investing. That first property that I bought, you know what I ended up doing is I refied off and I started my first real estate investment company. Here we are with the mayor of Bakersfield, California, cutting the ribbon. Pretty exciting day. I still don't think I knew what the heck I was doing then. I've learned a lot of lessons since then. Left California because I didn't like what was happening out there with the landlord laws and the pricing. Came to Jacksonville, Florida, and I found my new home. And again, my niche was always fixing up old houses, whether I was to rent them, to sell them, to work with investors on them. And again, it did create wealth for me. But this old fixer-upper model made me money, but it bankrupted my time. And again, this is about buying back your time. And I wanted to have time with my family. I'm happily married with 5 children. This is something I take very seriously. So I wanted my time back. And 10 years ago, my real estate investing took a turn for the better with new construction. I hung up my rehab shoes, and that changed everything. And from a very middle class kid, I consider myself very lucky because I set out all those years ago. My why was that active freedom. I wanted to be able to do the things my parents could never afford to do. So we can spend, warm winters in Costa Rica, cold summers in Nova Scotia, traveling for 6 weeks on RVs, lots of time with my family. We've been to I can't forget how many countries now, go back to see relatives in Ireland every summer, renewed our vows in Ireland. I'm still an avid surfer. All of this has been funded by my real estate. Another one of the best things that was funded by my real estate, I was able to donate a kidney to my father 12 years ago. And this was all paid for through my real estate. And I was the only one that had the space to go through the recovery process. Again, one of the big rewards of real estate. And it even got us to having a best-selling real estate book that my wife and I did with our team here at SI Homes, my partner, Chris, many of our clients, some of them that might be on here today. And this was, again, a playbook of the last 25 years of the journey we took through old fixer-upper homes to our new construction model now, and the wealth it's created not only for me, but many of our clients and team as well. On top of that, our real estate ended up paying for a best-selling Wall Street Journal book on family life for entrepreneurs. This is something I never thought I'd get the chance to do, but I'm very grateful for it, something we're very proud of, and it would have never come if I did not start to hold real estate and leverage off of it to pay for these types of opportunities. So what does active freedom look like? For us, talking with lots of investors, I've shared some of mine, but they just want to spend more time with their loved ones, upgrade their current health, pursue their passions and hobbies that maybe they gave up in younger years, travel worldwide, quit their job or sell their practice, bought a plane. There's some of you listening right now. We have a good friend, Tom. I know that he bought a plane with his last rental property. And also one of the proud things for me and others is they want to retire their parents and generational wealth. So that's what active freedom looks like for us. And that's something that we spend a lot of time doing is trying to create that passive income, active freedom for our investors. And we've been very proud to be able to do that with a number of people. And I'm going to talk to you about that. Again, I started in this little building in Bakersfield, California. I merged my company. It was with Chris and Carter and the team here on the left a few years ago. Now on the right, that's our new office. And you see that it's given us a really broad scope to say, wow, what can happen in a short time, focusing on the right type of real estate and forming the right type of team. Our company was built by investors for investors. And we have created a business I never thought would come to this level or this fruition. We work with wealthy and ultra wealthy people and help them build successful rental portfolio for long-term wealth without the headaches, without a lot of time into it. In fact, we aim for 1 to 2 hours a month for anyone to oversee their portfolio using our new construction turnkey system. Affordable new construction in affordable growth markets with low interest financing. A lot of you are probably hearing, oh, the finance, forget it. Interest rates are out of whack. Not when you work with us. We have our own in-house financing, and that will help to ensure cash flow. This simple slide, remember this, take a picture. This is the way that we are making money for our clients in today's market and ourselves. We have a very simple sweet spot that we've identified: single family, duplex, and quads, all residential real estate that we can put in key areas. And these have, again, we've done thousands of these now, and they've produced incredible results for ourselves and our clients. And we choose our markets closely. Again, I'm going to get into in a few minutes why we've chosen these markets. These aren't the most popular markets in Florida. You don't see Miami, you don't see Orlando, you don't see Tampa. A lot of you say, well, what else is left in Florida? There's a lot. And these second tier markets get into the fundamentals of where we've identified the best patterns of growth for you and the safest investments with better lower buy-ins and cash flow. So we'll get into that in a minute, but we're currently building in all of these markets. And these are the 5 factors we look for, and you'll want to look for wherever you go. Does the market you go into, does it have economic growth? Are there jobs going there? Is there population growth? Absolutely key. You want people moving there. Affordability. This is the word of 2025. Affordable markets will win. And we look for areas where there's a good average to the average price home compared to the average family income. It's called an affordability index, something you want to understand and look for to help identify the right markets for you. Is the area desirable? What's drawing them to the area? Are there amenities? Is it warm weather? Are there safe neighborhoods? Are there good landlord laws coming from the investor mindset? Something that is a key element to see if a market's going to grow or not. And obviously supply and demand. We want to go into markets and provide workforce housing, which is in a huge shortage right now in the US, especially here in Florida. We want to provide that in areas where there's so many people moving, there's not enough current supply. And that's kind of the order chain we're in right now with these markets in Florida that we're focusing on. We have 900 million under asset management right now, coming up to hopefully $1 billion soon. It produces about 56 million in annual recurring revenue for our investors. Over 200 million we've created for our investors in the last few years with equity. We currently work with over 1,000 active investors. That's a lot of individual investors, a few of the institutions and larger family offices as well. We've developed over 9,000 units, house over 10,000 people right now in workforce housing. We have a team of over 120 that's growing by the week. And a minimum investment to start working with us is $80,000. Now, to be clear, we are not for everybody. You know, you might not be at that starting point. Gosh, I know it 26 years ago when I bought that first property, I wasn't at this point. But for the successful start, this is a minimum investment requirement. So we know we can do our job to get you a portfolio built without putting you in over your head. So that's a minimum investment requirement. And we currently own over 5,000 lots here in Florida. And we plan to build all of those out in these key markets that we're seeing those 5 factors. And again, a low buy-in price. We're all looking, saying, is the market overpriced? I always say it depends on which market you're looking in, not in the markets that we're focusing in now. So wealth, independence, security are not just the products of work, guys. A paycheck can suddenly stop. And you're always trading hours for finite dollars. And that cannot last forever. And there are lots of ways. So a lot of you have said, fine, I understand that. I understand I have to start to invest my money. How do I do that? Well, let me talk to you about this. So this is kind of the investor triangle. Starting at the base is what more people do. And as you go, it kind of gets smaller to achieve success. So at the effective level, the base level, it's the fix and flip. You know, you hear this, I'm going to fix a property, I'm going to sell it, and I'm going to make a profit. And this can be a great way to start to learn real estate, to get involved, especially if you have time and like to roll up your sleeves. But there are tax implications and it can burn you out. But it is a starting point. The next level is the do-it-yourself landlord. You're looking with realtors for a house, how to fix it up. You're going to manage it yourself. And this can be a great way to earn and provide wealth and generational wealth for your family. It is time consuming. Some of you, again, have a lot of time. You want to go into it. And it can be, again, a solid level as long as you have the time commitment and the perseverance to handle your own tenants, because that's not always the funnest thing. And that's one of the biggest feedbacks we've got for people who have come to us. And then there's the level that we work at called the turnkey real estate 2.0. So turnkey real estate was a term that came popular just past 2008 after the first meltdown, when there were a lot of people wanting to get into real estate investing in different areas of the US, but they didn't live there. So they would hire people like me and Chris and some of our team to find them properties, fix them up, manage them. But again, these were with old properties, old foreclosure fixer-uppers. These did really well for me. Again, they created my initial wealth, but they have their issues. And we don't like issues, especially when we're working with investors who are in a, in a whole different time zone. They can't get to things easily. They're busy with their job, their practice, their business. So about 10 years ago, we stopped rehabbing old properties and we went to the new construction model. So as a turnkey, we provide everything. We build the property right for you, we get it financed right for you, and we manage it right for you. And we don't do any old fixer-uppers anymore. The TV shows might be lying to you guys. I'm letting you know, and we'll talk about these lessons today. New construction is a totally different angle, a totally different strategy, and it's what's, again, made me more money, but it's also freed up my time. And that's something that is extremely precious to me. So without your money working for you, you'll never stop working for money. We got to get investing. Again, to get that first property that I showed you, that 432 North M Street, I've told this story a lot, but that time I got the call from Tammy Atkins, my first realtor buying that first house. She said, Jim, your offer's been accepted. I said, Tammy, let me call you back. I hung up the phone. It was still a wall phone. And I was standing in my rental property and I started to hyperventilate. I was so nervous that I had gotten a deal accepted. It was a blessing and a curse. But I had done my numbers, I had learned some fundamentals, and if I hadn't done that first deal, then it would never leverage forward into all the things that I showed you guys so far tonight. So assets finish ahead. Even if you're trapped in good income, it's hard to build wealth. It comes from setting a growth asset base in motion. You can focus on accumulation while still extracting cash when needed. So this is the beauty of real estate, right? We're going to talk about the 5 ways you make it, and cash flow is great, but real estate through the first world country histories has always shown an asset-based equity growth. And if you get into it, the right fundamentals, the right management, this is, again, 8 out of 10 millionaires in the US have made their money this way. And that's the program we try to plug into. So here's Tom. Tom's become a good friend. He's built quite a side business for himself without a lot of work. Again, he wanted boring. He did not want to get involved. He said, I don't want to be involved in Airbnbs or anything that takes up my time. I just want simple properties with long-term renters without a lot of headaches. And in a short time of 4 years, he built over $1 million in equity and almost $12,000 in monthly passive income. His wife, just like me, I'd gone through that kidney donation with my father. Tom's wife was going through kidney donation as well, and he wanted to be there with her. So he said, I want to be with my wife, and I want to continue to fly. He's former Air Force and wanted to continue his hobby of flying. Well, here Tom is with his private plane, and he financed it with one of his last rental properties that he had bought with us. And also, Tom used to run a mortgage company. And on July 1st, 4 years ago, I got this email on my Facebook account. We were talking back and forth about some of our kids, and he said, oh, by the way, I retired from Fairway Mortgage yesterday. You played a big part. Your team did. Thank you. We love emails like this where he was able to be there with his wife for her kidney donation. She's doing well. He's still flying his plane, and that's, again, passive income, act of freedom. All these things, just that new plane, retired with the help of our rentals. He's done with his mortgage company and still honoring his former Air Force days flying. It started with this one simple duplex in Southwest Florida with a minimum investment of $88,000. And he grew it from there into 4 more properties and then another 3 from there, and is living off that partially for his now happy young retirement. There's 5 ways, guys, to make money in real estate. And you want to remember this. There's appreciation. This is a pretty controversial one. People say, don't depend on appreciation. I say, okay, I don't depend on appreciation, but I'm going to do everything I can to get in its way, because that's what's produced the most wealth for me over the last 25 years. So I greatly believe in appreciation, planting seeds in the right market. I believe in leverage. Allison used to be in the Wall Street game. She'll tell you, if you're going to buy $200,000 worth of stock, normally you're going to need $200,000. You buy a $200,000 property, well, heck, you only need $40,000. That's the power of real estate, where you can leverage, where you can put certain money down, leverage the larger asset, keep the whole upside for yourself, and again, make a cash flow along the way. That is incredible leverage, again, that stocks don't get. And while this is happening, your tenant is also getting debt pay down. So if you have a mortgage of $200,000 and every year it's chunking down, it's nice to look back 10 years later and say, wow, I haven't paid down any of this debt. My tenant has. And that again increases your net equity. There's tons of tax benefits. Again, I'm not an accountant. We bring some accountants on here, but the depreciation, the favorable tax treatment on your cash flow, you cannot overlook this, and is one of the best ways I know for myself to continue to shelter income and to move my wealth forward. And finally, 5 is cash flow. Absolutely. I like to get monthly checks on my real estate. I will always sacrifice a little bit of cash flow for a better quality property. That's one of the lessons I've learned from doing the wrong properties for a number of years. But cash flow is important because I want my properties to put money in my pocket every month, and they should be able to. So again, our plan for 2025, and something I would encourage you, whether you work with us or not, affordable new construction in affordable growth markets with those 5 factors, providing low interest mortgage financing to help ensure cash flow. Again, we'll go over that tonight. That's real important. And you got to have world-class property management in place, which I'm proud to say we have. And we'll talk about it again. Part of our program, build it right, finance it right, manage it right. You got to get all 3 of those if you're going to do new construction turnkey rentals. Here's just one of our homes. Allison lives right near here. Beautiful ranch. Her horses are out there. Ocala, one of our star markets. In fact, I'll give you guys a little sneak tip. In about 3 weeks, I'm doing our webinar for my favorite market of the year for 2025. It's Ocala. Why? Because those 5 factors are extremely prevalent in Ocala right now. And you can still see the pricing. High quality single family homes still under 300,000. I mean, my friends in California are going, holy moly, what is something wrong with this? Is there only one wall in this house? No. This is the affordability of Florida and the markets we look for. As you can see, this is how Tom or others, and I'll talk about tonight, started the building blocks of wealth. They're having a cash flow starting off, but again, the cash flow is good in putting money in your pocket. But what we'll go over, and again, when you start to work with us and go through market reviews and portfolio reviews, performer reviews with someone like Allison, you're going to start to go over the real IRR, the real holding period of that long-term buy and hold. And we're estimating on conservative numbers that have been hitting many, many years, 5-year hold of $138,000 profit. You know, that is something really helpful to any of our wealth with that amount of money. And that's just with the start of one simple single family home. Also duplexes, you know, here's one of our Ocala duplexes right now, under 400,000. So you're getting 2 small houses for under $200,000 a piece, producing a great cash flow and a 5-year hold of over $200,000. And again, this is based off of very conservative, under the average rental growth patterns, debt pay down, and appreciation. Allison or Jen or one of our other counselors, Austin, will be able to sit there and go through the numbers with you to say, how is that possible? You want to understand how performers work. And again, one of the key things I have to definitely impart to you guys, learn how to use and read a performa. You're going to be able to do that with our sales counselors. They can walk you through. They've bought properties personally themselves, built dozens of portfolios. This is absolutely key. Jacksonville Quads. I was just out there today with one of our larger sales partners that does a number of properties with us. Quads are an interesting beast. They are almost a commercial property, but you can still get residential financing. You get 4 tenants under one roof. Yes, they're a larger buy-in, but they can also produce a really good cash flow, and their hold period, when bought right and not timing the market, but time in the market, is showing quite a large return at a 5-year hold. This is, again, why I've really appreciated that I started that 26 years ago in holding properties just like these for the long term. Now, important point, how do you get these done? Savvy investors use proven systems, strategies, and guidance to make money in real estate by producing repeatable results. And we are doing the same type of properties the same way in the same areas over and over and over again. And again, we have 3 dimensions that we fill in the gaps on. And if you're going to go into property investing, you're going to have to fill these in one way for yourself, especially if you do new construction. We get it built right for you with the type of properties I just showed you, with the fundamentals around them of those 5 things: economic growth, population growth, affordability, desirability, healthy supply and demand. We get them built right. Also, we get them financed right. This is so key. Today, our friends that were here that we've done a number of property, they're closing on a beautiful home in New York. Their interest rate is 7.4%. They've got A+ credit. and they're at 7.4%. Right now, we're locking in long-term debt for our investor clients at 3.75. 3.75. What that does for some of you that know some of the fundamentals of cash flow, that's the difference between having negative cash flow or positive cash flow. And so our in-house financing program is one of the things that is really setting us apart, that we have the balance sheet and the financial statement to be able to work with banks. We actually buy large tranches of money and pass the savings on to you, our investor. But wherever you go, you want to be able to finance right. The interest rate that you can get is key. So we end to finance it right and then manage it right. Properties have to be managed the right way, or you can lose money, no matter how good a deal or good the property is. So again, our in-house financing, you can look at this, you can get 3.75, you can get 4.25, 4.75. We're beating the market by a few points, and we're giving 2 years of free property management to help the cash flow for those first few years, which when you buy a property, those are the most important years. So you want to get the right property with the right momentum. Property management. Again, we are managing over thousands of properties now with Suncoast. These are just a few of our happy clients. Property management is a tough part of the game. When we were getting out of managing older fixer-upper properties that really were challenging and not the best areas, the new construction has been a breath of fresh air, a lot of work to get into, but you want your properties managed well. Again, the only way you're going to be able to buy back your time, at least for me, because I don't like to manage my own properties at all, is you want to be able to have a good property manager, and it's called manager property manager. You get to have a close relationship with your portfolio manager, overseen, receive your statements every month. Again, if good property management in place, you can have a portfolio and not spend more than 1 to 2 hours a month on it, and that is our goal. Our Suncoast group makes that happen. Now, you say, great, well, what do the returns look like? How have the returns done? So let's look at some returns on basic investment options and our model. If you had invested $250,000 5 years ago in the S&P 500, you would earn a little over 10%. Solid return, great return. If you had invested in a good real estate fund, again, those can be hard to find, a little tricky sometimes, but let's say you had, and you invested $250,000, well, you could have earned 13.5% on your money, which is a great return. But again, it's not active. Direct property ownership has its privileges, especially over the last 5 years. And if you had invested $250,000 into buying a few of our Jacksonville rental properties, new construction 5 years ago, you would have earned an average of over 69% on your money year over year. That is not a misprint. And that is the power of leverage and buying the right type of real estate in the right type of market with the right management. Again, it comes down to that economic growth, population growth, affordability, desirability, healthy supply and demand. Guys, I say this in my sleep now. This has been my North Star, my guiding light. It's something you want to take with you. And again, I like to show this one. People have always said to us, well, why don't you guys build in Alabama? I like Alabama. Pretty area, nice people, but look at these numbers. We like to have population growth wind at our back. Look at that hockey stick red line representing Florida and that flat line of Alabama blue. Just not enough people there are going there. We don't like to put ourselves at risk in building operations. We don't like to put you at risk for finding tenants. So again, Florida is our main vein focus, with growth happening right now into Texas and Tennessee, and it's something you can talk to your property counselors about. Now, let me give you a quick 5 common pitfalls of real estate investing, something I've identified very, very pertinent for today. First, short-term thinking. If you are looking to just get rich in 6 months, by flipping a property, holding it, it's going to double in value, you are speculating, you're not investing. And that's something that I don't encourage. If you are only looking, 12 months or less with building this rental portfolio and it's supposed to retire you, I think you're cheating yourself. You can't think short term. You need to look out a few years. And then if you even get seeds planted, and you'll have the courage to look out a few more years, that's when the wealth really starts to set in. So you got to avoid that short term thinking. Do it yourself. This is very dangerous. A reason I say it is, we have tons of investors from New York, California, more expensive areas with not the best landlord laws. If they try to do everything on their own, find a realtor, go out and find a property, get it fixed, manage themselves from afar, it can be very dangerous. I'm not saying it's not worth it or you could possibly make more money, but you are putting yourself at risk because everything is new and your team is untested, your systems are untested. So from afar investing, do it yourself, has really hurt a lot of investors. Chasing cheap is the other thing. This is something I write about in our book that I showed you before. I will always sacrifice now the amount of properties I own for better quality properties. In fact, my motto is own less of better quality with less leverage now. When you chase cheap, when you chase the cheapest homes available in a market, those neighborhoods are usually very hard to resell. There are usually lots of turnover, lots of maintenance and repairs, lots of crime, very hard to manage in. And I've watched a lot of people, if they had just bought a little higher quality property, would still be on a growth forward with their wealth. But instead, after a few years of buying a few of these cheap properties, they raise the white flag and they sell at a loss, which is really sad. So don't chase cheap. You want to go, again, a little nicer of a home, closer to the median value in the markets you're investing in. Misdirected charity. What does this mean? I don't manage my properties for a reason, because I wasn't very good at it, and I took more excuses than I did checks when I first started managing my own property in California 25 years ago. I call it misdirected charity. I have a lot of causes that I care about and charities that I give to. But what I learned early on is if I gave charity to my rental properties, I wouldn't be able to give charity anywhere else. So misdirected charity is not a good idea. One of the ways that I stay away from that is I don't have to put any emotion in it, because I hand off the management to a good professional property manager that can be fair, but also make sure things get done better than I did. So be very careful of combining charity with your rental properties. When you get into it, it can be a recipe for disaster and financial ruin. Wrong partners. We're seeing this right now, guys. There are probably 4 or 5 builders that have come into our radar the last 6 months, and they have gone broke while building investment properties for investors. And that's very sad. That puts them in a dangerous situation, everyone in a dangerous situation. So you got to pick the right partners. You got to screen them. What is their financial viability? How much work have they done? Are they able to bond larger projects? What is their bank debt? I mean, these are questions you need to be able to ask about your builder. And also, are they building new pre-construction, or are they giving you a completed property? We only do completed properties now for our people and don't do pre-construction because it makes it less risky for them. So be careful about who you're partnering with. Prosperity in the Age of Decline. This book had a huge influence on me. I'm always looking for really solid, unemotional, apolitical guidance in the economic landscapes. And these guys, these 2 brothers, have been great. They've called everything ITR economics accurate about 94% since the early 80s. And when they put this book out about 12 years ago, it was a guiding light. It was my North Star. I was able to figure out the type of properties we were doing in the areas, but we switched from old fixer-uppers to new construction. And again, they are telling me things today. I've been in their, economic forum for a long time, that we're about to go into some exciting times. You look at this. We talked about time in the market is more important than timing in the market. But if you can get both, nothing wrong with that. Since June of 2022, we have had some serious interest rate increases, 26-year high recently, which put the market into a more, I don't want to say recessionary effect, but flatter effect and some drops. But as you see now, as of December 2024, they're saying that housing is just ending this interest rate recession and about to go into an actual recovery and accelerated growth. That's a very exciting 4 or 5 years ahead of us, guys, at least. So again, I listen to groups like this, and this is something we're gearing up for this year. So again, our plan is affordable new construction, affordable growth markets, low interest financing to help ensure cash flow. Our most successful investors, everyone says, well, what's it take to get success? Do I need to own 100 properties? I bought into that. I went into that contest of the 100 House Club. I actually doubled that. But the problem was they weren't good houses. So it sounds like a big accomplishment, but if you can do it with way less houses and way less headache, why not? And what we're actually seeing now, for people who want a real residual income, something to lean on, our most successful investors own about 3 to 8 properties. We have some that go up to 25, and some of the bigger institutions a few hundred, but 3 to 8 properties produces some sort of effect for them. So don't overwhelm yourself when you don't have to. Again, this is very doable, and our property counselors have plans that you can go through to accomplish that. And here, Adam accomplished this. Become a good friend. We spend some time together. We've now gone on vacation. He was just a random call that came in through one of our sales groups. And he had already been investing in Utah, but the numbers weren't making sense anymore. So Adam started to go pretty aggressively into our markets starting in 2019. Bought a number of properties and then leveraged it into more deals here that I wasn't even involved with, and that's fine. We always encourage our people to continue to grow, but bought several properties with us. Right now, he's earning over $20,000 a month. $20,000 a month, almost $3 million in equity in 4 years, and it's a proof that asset owners win and job security loses, guys. This is something very serious. This is why what you bring in has to be invested. Again, when I did that first property and I had a sales job that was not bringing in much, it was a lot to get into that first property and then the next one and the next one. But that's what's allowed me to win. It's not that I'm smarter, it's that I took that action step because it's hard to keep up with the market and the real estate growth. So why join our investor community? You're going to have access to ongoing educational videos and market updates. It's a done-for-you program, with one-on-one coaching from our counselors. They're going to help you do your goals. They've done this for so many people, created a lot of millionaires, invest themselves. They hold your hand and educate through the entire process. You don't understand how insurance works. You don't understand how financing works. You're unclear of the best structural design for new construction. They can go through all this with you. Again, we're going to show you how we build it right for you, finance it right, manage it right. All for you, all done for you. Built-in coaching, ongoing support systems. We support you, through the life of the property. And it's something we're excited. Again, I know a lot of people have said, let's take a quick walk around. So again, come with me, guys. I'm the last one at the office besides me and Jaden, but I do want to show you our new space because we're excited and we've set some big growth patterns to go through here. So I'll walk through. If you look here, we're going into one of the main areas of accounting right here. If you guys see, this is our accounting department right here coming through. Obviously, with large development projects, property management, sales, marketing, you need a good accounting department. And, we've been very blessed to have that and build that. Moving on here, we're going into sales and marketing and our property counselor section. Again, our property counselors for you are probably going to be your best friend. Because they are the ones that are really with you in the trenches, along with your portfolio manager, for the long term. But they help you pick and strategize the portfolio you're going to build. Again, these calls are so invaluable. And what I've learned is people say to me, I'm so glad I worked with Allison or Jen or Austin to help me decide not only the properties to buy, but the timing. You might not be ready to buy 1 or 2 or 3 properties right away. Within 6 months, but maybe over 2-3 years, you can leverage into a few more and a few more. So very important. This section is something that nobody talks about, but it's behind the scenes. And that's the permitting department, the purchasing department. Through the pandemic, when you look at that, man, that is a full-time job, finding the right people to do the work and to get the prices right for the materials. And if we don't do that right, we can't make any margin for ourselves or get you into the properties right. So that's very important. And a lot of you worked with Haley and our team on the closing department. If you've ever done properties, we want to make sure your closings go really easy, really well, without a lot of headaches. So again, let's go over there. Some more construction management. And our team, Becky and Leslie, really built out the office well. It was the 2 masterminds. You don't want me doing something like this. But again, large kitchen area. You can see what our team's growing on. If you come in for a tour, which we love to have people come in on tours, this is probably the favorite thing, the fancy schmancy coffee perks. I had an Americano a little while ago because I'm the last one at the office. And anyway, wanted to be awake for you guys tonight. Last, but certainly not least here, let me get you down. We are going over into the property management side of the building. Property management, again, remember my first mentor saying, you can get a house at 50 cents on the dollar, but if you don't have good management in place, you could still lose money. So property management is one of the things we're building out the most significantly and with the most focus over the next year. So you can see one of the larger areas here No one's in here now, but these are the people that really make things work for you, that keep your tenants happy, that screen your initial tenants, make sure your maintenance and repairs stay low, overlook your asset for the best results. So I can't stress enough the importance of this group and that ongoing relationship with the property manager, your portfolio manager is absolutely key. So I just wanted to show you around. You can see we are poised for growth. We are absolutely poised for growth. One joke from the office. This is the only guy working later than me right now. Pretty good one. So, but we are really poised for growth. And one thing with our new Japanese partner, Sumitomo, they wanted us to be set up to do that. Again, with Sumitomo aboard, it's very exciting. We have zero bank debt, no bank debt. That's a big accomplishment for a builder, and we're also able to get this cheap financing for you. And they wanted to set us up in a great office that we could really, really benefit from. Here's our front area, and again, you can get across to the kitchen. So anyway, this is probably my favorite thing. We went by the office before, but my mastermind room here that if you come in to see us, this is one of the spots that you'll be seeing me in the masterclass. But again, I really, really enjoy the new office because with you guys coming to visit, we wanted to have a better space to show how serious we are about building your wealth for you. So I want to open up things to a couple of questions. Oh, one more slide. Amina, great person, infectious disease doctor in New York City, wanted to supplement her income. She bought a couple of quads with us, a couple of properties, two more. She's sitting at a little over $6,000 monthly cash flow now, and almost $1 million in equity. Really happy for Amina. She's got a young family. She's a great doctor. She doesn't want to retire, but she wants something to lean on down the road. So next steps, guys. You got to go to Southern Impression Homes, request a call. Get involved in our investor community with the videos, the newsletters that are coming out. We are really trying to keep you up to market date, not only with market updates, but also investor fundamentals that you might not hear from other people, where we just try to share our story of what has succeeded for us and what's failed. That's whether you work with us or not. Obviously, we want you to work with us, but whether we're a good fit or not, we want to help your journey. And that's going to allow you to have that passive income active freedom. But the starting point is booking that call with your property counselor. You're talking about a no obligation call that can set you in the trajectory for real estate investing. I wish I had someone like this I could make a call for 26 years ago when I was feeling my way in the dark. You guys don't have to do that. Again, we can guide you. You can stand on our blood, sweat, and tears. Starting point is this property counselor call. So I'd like at this time to open it up to questions. Let's see. As Allison asked it. Now I do have, let me start with one question off the bat. And then I might have Allison chime in to see. It looks like Allison's been answering. But let me tell you guys this. Insurance. I call it the I heard. This is my I heard list. I heard you can't get low interest financing anymore. I heard, another one, you can't get insurance in Florida. How many of you guys have heard that? It's a pretty big a rumor going around the mill right now that you can't get insurance in Florida. This is not true. And always when someone says, I heard you can't get insurance in Florida, I kind of smile and say, which property? There is a huge difference. Remember, insurance companies are all about risk. So they do risk assessments. They have these big fancy algorithms and spreadsheets, and they analyze risk. And the bottom line is the type of new construction we do, they find very low risk because how they've performed through storms, through wear and tear, I'm sorry, I'm forgetting the word. It's the insurance claims, the low insurance claims. Thank you. Forgot that. See, I haven't done a claim in so long on a new construction. I forget the word. But seriously, what you have to do is look at the actual insurance rates. We do not have problems getting property insurance on any of our new construction properties. Why? Well, houses that I used to rehab from the 1950s, they were built at about 2 feet or 3 feet above sea level. Today, anything built 2004 or newer, you got to build up and bring in dirt to go at 13, 14 feet above sea level. That's a major difference. And the biggest issue with hurricanes is flooding. If you are that high up, it's very hard to flood. These older houses, they can have half the size of home, but have 5 times the insurance that we have, the cost, because we're that much less of a risk. Plus, the way we build the new construction with stronger structural design, stronger fasteners, puts the insurance company in a better situation. So this is one thing that you really, really want to look for. I want to ask Allison, do we have any questions? What is
Yes,
the best
we
view?
do. Yeah, we got some
Okay.
great questions. I hope you don't mind. I've just been answering them here. Do you want me
Well,
to read
that's,
the questions
hey,
or?
that's called teamwork, and you probably answered them better than me. So is there any you want to start at? Because,
Yeah,
I said a
let's
mouth.
just read the questions here. So, Nitin Butala asked, "What is the difference between short-term rental versus having an annual lease with the renter, and how do these two situations work from tax savings and a benefit standpoint?"
Okay. So that's a lot to go down. Short-term rentals can
Mhm.
be a great way to make a larger cash flow because you're renting by the day instead of by the month. I own some short-term rentals. It's not my main focus. I'll tell you why. We don't do short-term rentals. We used to own a small rental portfolio of about 60 and we sold out of those. The reason why is long-term rentals are our focus, and short-term rentals have a lot more management intensity, a lot higher costs. So you might be paying up to 25% of collected rents for management fees opposed to 8%. And what we've seen in Florida is two things. One, a lot of people through the pandemic started to try to just make any property a short-term rental. And this flooded the market with it. And when they're saying, oh, I'll probably be able to get 20 nights a month rented, they were only getting 4. That can be a dangerous situation. You're buying a more expensive house. It's just not something we focus on. Now, I'm not saying you can't make money, but it's not something we focus on. Where we have the most success, and again, we're looking to hold it long term, is to get you into something that's performing and it's going to go long term. So we only do that new construction model on long-term rentals. We have the most experience. And one thing we know about long-term rentals too is they're not going to be banned. There are several areas in Florida that have come in into different neighborhoods, different municipalities, and those sections, I know it happened in part of St. Augustine near where I live, they banned short-term rentals. So you thought you had this short-term rental that you were going to be able to rent by the night. You spent all this money on furniture and such, and now you're only allowed to long-term rent it. So hopefully that answers your question. I own both properties. I'm just telling you why we personally do not work with short-term rentals anymore. We only focus on the long-term rentals. Was there anything else on that, Allison, that I didn't
No,
answer?
that was great. That was great. So thank you so much, Jim. Let's see. Do you want me to continue to give you questions we've already answered, or should we get some fresh ones that we haven't
No,
answered
if there's some fresh ones,
yet? Okay, let's mix it up then.
I have one that did come in right before I got on. It's the
Cool.
worried about how do I know? Because a lot of new investors or even experienced investors that have come to us, I'm worried about tenants. How do I know tenants? That's where management steps in. How am I going to find the right tenants? In order for our system to work, you have to have a right tenant in place. And so you don't have to use our property management. You can do it yourself. But if you are using us, then you don't have to worry about actually screening the tenant. I mean, there are several steps in our protocol to approve a tenant that you don't have to worry about. Our property counselor will show you what that is, go through a slide deck of how our management works. But again, you don't have to personally worry about getting that tenant screened. That's our job and we need to stand behind it. So a lot of this worry has come up of what happens if I pick the wrong tenant? You're not picking the tenant when you work with us. You're trusting in our systems, our protocol to find you that right tenant. Allison, did you have another one? Did we answer the
Yeah,
question?
I have a bunch of questions. There's so
Okay.
many questions here. I hope we can get them all in. So this one is from Karen Dudich, Jim, and she said, "Could you possibly explain the APR being somewhat different from the promotional rate offered?" And I know you and Chris
Absolutely.
just did a great video on that. So yeah,
Isn't that
that'd be
funny?
awesome.
Let's give a little system breakdown of our team, Allison. So we get together a few times a week, and every Tuesday morning we're always looking at opportunities and concerns. Months ago, Allison brought this here where people were confused on this. Why does the APR appear different than the interest rates? And what our solution is, anytime there's this question over and over, I'm required by the team to do a video on it, me or my partner Chris, and I love that. So we develop a video library of answering these questions. We've actually answered this question recently before, but let me give the skinny over this. The reason why the APR shows higher than the actual interest rate is the APR is a formula that also includes those initial closing costs and points that you pay for your loan. Now, you can see to get these rates, we're paying a lot of money to buy it down, but you do have to pay some origination finance points to get this low rate. Those points are averaged into that first year when you're paying these one-time fees. That's why the APR shows that's averaged into the interest rate. That's why it bumps the interest rate on the APR higher, because it's including those costs. And the normal interest rate, though, is really that 3.75. But the APR, it's a government requirement. I can honestly tell you in hundreds of properties I've bought, APR was never a concern of mine. I didn't look at that number because I knew, okay, I'm paying some fees up front to get the loan that I want, but what's my real rate moving forward? But that's why the APR shows a little bit higher than the actual interest rate you'll receive. Again, I break it down further in the video, but hopefully that gave you at least a baseline.
That's awesome, Jim. And I also texted with Karen. If she wants to send me her email, I'll be very happy to get that video in her hands so she can watch that.
Awesome. Thank you, Allison.
Cool. Here's another one from Kirsten Francombe. She says, after the 2 free years of property management, what are the property management rates?
8%.
Wonderful.
8%.
That's an easy one. It's always been 8% as long as I've been alive, and I think for you too, Jim.
Well, I mean, for us, for our business, but you can go to some other areas in Jacksonville or other markets, and they might start you at 10 to 12%. Since again, we try to do volume, we start you at 8%.
Great. Thanks, Jim. That's awesome. Here's one from Danny, and Danny says, I understand Southern Impressions will be expanding into the Texas and Tennessee markets. Could you tell me when that will be happening?
We are looking at dates. We are already building there for some larger institutional buyers that we work with, letting them test the market. Always let them go in first, and we build for them, see how they do. And then once they've tested the market, then we're more comfortable letting our individual investors work there as well. But my estimate would say, look, they're on the radar, but to really get into them could be about 2 years or at least a year and a half.
I agree, Jim. Let's see. Here is another one from Karen Dudich. She says, do you see an overbuilding proximity of rental units currently in your quad units in Jacksonville causing short-term issues of vacancy? Great question, Karen.
Great question. So Q2 of 2024, a lot of what's called COVID inventory came on the market. That was, everyone was delayed on supplies. They got them and then finally got the properties done. A lot of units came on the market in Q2. This did slow us down from about an average 30 days to about 70 days on properties like that to get them filled. The good news on that is we are starting to see that come low. Some of our units are filling very quickly, but what we're seeing at this time is a drop in the inventory levels. This is all being absorbed at this time. And since we've had, again, like I showed you, this recessionary period of people not pulling permits because the interest rate spiked, we're seeing by Q3 of Q4, all of this year, all of this inventory should be worked through, and we're going to be back in an inventory shortage. So the short term, yes, we're seeing that. We've lowered some rent on we've only lowered rents on one of our quad developments to get them rented, but then we've been showing the numbers to our investors in this quad development. I don't think we might have one building left in that for even sale, but this is not going to last forever. And we're showing this by the stats showing for the actual inventory levels. Again, we're expecting a result, and this could be, again, a guess, but it's happened historically. When you have an inventory shortage, we saw this before, rents jump and values jump up. So we're hoping the same thing will happen for these. If you're looking for a quad in Jacksonville and you're talking to Allison or Jen or Austin, there is nothing wrong with looking for units that are already rented. So if you're concerned about vacancy, we do have quads and duplexes and single family where the properties are already pre-rented. So if that's something of great concern for you, that's what I would focus on.
Awesome. That's wonderful, Jim. Thank you. Let's see. Todd Thacker had the same question as Danny. He was curious about Texas. I think you already got that one. And then here's a
I
great question.
can, I,
Oh,
I
go
will
ahead.
say on that, Allison, I like Texas and Tennessee guys, but my rankings are absolutely Florida, Texas, Tennessee. So of course I'm the barber telling you need a haircut. I'm a Floridian that likes the beach, and wants to be here, by the beach in warm Florida. Well, it's not very warm now, but normally warm Florida. Florida is our first pick. It's where we have the most experience. It's where we've created the most amount of millionaires. It's where we're going to continue to focus the most, and those others will be outpost opportunities. But if you're really looking for the most predictable, the most sustainable, the most proven, it's our Florida markets by far.
Awesome. And here's a great question from one of my longtime investors, Ray Posadas, and he
Right.
says, are there new build to rent single family home development communities planned for Florida, either now or in the near future?
Is this when we build out the whole community?
I think that's what Ray's alluding to. Yeah, he's talking about a whole, maybe like Panther Creek or
Like a
something.
Panther Creek. That's what
Yeah,
I
that's
thought.
what I'm
We have
thinking.
lots
Yeah.
of things coming up, Ray, depending on what you're looking for. Again, Allison can go with you on a discovery call, the inventory coming up. We have everything of our recipe combining single family, duplex, and quads coming up. Again, we are green light right now on our building. So meaning a lot of other builders have pulled back. We are full steam ahead right now.
That's awesome, Jim. Thanks. And I think, do we have time for like one or two more questions?
Yeah, let's do one or two more. If we go a little past the hour, I'm fine with that. I appreciate everyone staying on.
Perfect. Okay, so this question is from Rob Allen, and his question is, where do you see the largest opportunity for future appreciation, single family, duplex, or quads? Great question.
Um, So here's what I've always said. I love our menu of options because it's residential real estate, so it stays out of the commercial, huge dips and flows. I've always said the single family home is the most proven asset where you'll take the lowest amount of cash flow, but normally will have the highest equity growth. Flip over to the other side where the equity growth might be lower sometimes on average on a quad, but the cash flow, especially with 4 units, and if the market goes up like we saw 2 years ago here, there can be an substantial amount of cash flow growth in those multiple units. So it can go either way. In the duplex is really interesting. I like duplexes a lot. Some of you that know me well, I talk about this a lot, own duplexes. You can build them in single family home neighborhoods and act like you have two single family homes on one lot, but they're more affordable. But people still feel like they have their own home and they couldn't have their own home in this way or have to go to an apartment with that. Also, resaleability down the road. A quad, you're probably going to sell to another investor down the road. We have had some quads be bought by owner occupied people who live in one unit and rent the others, but it's normally an investor. Duplexes, again, the single family homes are a great way where you can sell to a first time home buyer. Let's say you hold 7, 10 years, the market's gone up, you want to cash in. I know that you can still sell that to a first time home buyer excitedly because it's a newer home. We've built them right. We've put great aesthetics into it. But the duplex, again, you can almost have the best of both worlds because you're in those single family home neighborhoods. We know lots more people that are owner occupied buyers that they were like, hey, we'll live in one side and rent the other, or we have family that's going to move in there. And so those can be very lucrative. I'm excited right now about our duplexes coming out in Ocala that I'm sure Allison has talked to some of you about. But again, each one of them has different strengths. One will go from stronger equity growth, less cash flow, to stronger cash flow, less equity growth. And then obviously our duplex sits in the middle and sometimes can experience both.
Awesome, Jim. That's great. Okay, we still have time for one or two more.
Sure, let's do it.
Perfect. Okay, this comes from Kishore Patanjali. Kishore's question is, concentrated development of BTR, built to rent properties in a neighborhood can indeed lead to concerns about property value stagnation or even declines.
Yep.
These concerns often stem from factors such as oversupply, limited owner occupancy, or perceptions of transient tenant bases. How
Yep.
do you address and mitigate this concern? Great question.
Great question. So let me be clear. We do build communities where it's funny, the BTR build to rent niche, with Wall Street Journal getting a hold of it and the institutions, what it was pictured, and this is some of my really experienced investor friends' eyes, they thought it was you go into an area, you build out 200 single family homes in one neighborhood, they're all rentals. That's true for the institutions. The institutions think like this, they look large. The concerns that you just raised have always been mine. I said, well, where's the homeowners? Homeowners have pride of ownership. They have first-time home buyers buying them out. You own a whole neighborhood, it's all a neighborhood of renters. This can be a concern. And I was taught in my original days, go to affordable markets, not the bottom of the barrel, but closer to the median, where there's a combination of homeowners and renters, kind of that 50-50. Half of the homes are rentals, half of the homes are owner-occupied homeowners. So we do build some of those, but not for our individual investors. In fact, one of the things that set us apart as a builder, again, from my background and Chris, we went by that law where we want to go into neighborhoods where it's a mixture of homeowners and renters. So a lot of what we do, especially for our single families and duplexes, is we build infill lots. So for example, Palm Coast. You go down to Palm Coast, beautiful market, very coastal. It looks like one of more of our upper end markets. I got engaged there to my wife, myself. These areas you would drive through at 9 o'clock on a Friday night, no problem. That's one of our rules. And they had a lot of empty lots in these established neighborhoods that have been there 25, 30 years. Well, we bought up hundreds of lots in these areas. We're able to build a combination of our single family homes and duplexes. And there's again a lot of homeowners in the area. So that classic view you think of the BTR thing of, oh, it's just one solid neighborhood completely built and completely rented. That's not what we do. The majority of what we do with our individual investors is this infill lot in already existing established neighborhoods with a mixture of homeowners and renters. So that is a great observation. It's one we had concerns with as well. And again, we build for some of the bigger institutions, but we can't make up their minds. I've shared your same concerns. They have different pockets than us, different rules than us, and said, okay, you want to own an all investor-owned neighborhood. That's what I always was taught to avoid. But again, each of us has our own investing strategy. For you, the individual investor like myself, I have the same concerns. That's why we do infill lots in existing neighborhoods.
Wonderful. Okay, let's see. Here's one more question from Karen Dudich. She says, I have seen in duplexes the yard has no divider of any type. Is this something that you can add?
Absolutely. And we hear this a lot. But again, it's something that we did on some of our initial units. But again, trying to keep things nice but cost effective, we stopped. And what I project in my own concerns didn't always translate into tenant concerns. So for you and I might say, gosh, we really need the fence. We want that divided. We haven't seen a need for that. And people haven't been concerned or lacking appreciation for the setup. Because again, you got to remember, a lot of people that are renting a duplex, again, like I just described in Palm Coast, in a nice, mainly single family home neighborhood, are getting into a neighborhood they normally couldn't afford with their own yard. Where opposed to not going into an apartment building with a dog and two children, they're having their own yard at an affordable price, better affordability than a single family there. So that makes a big difference in expectations and gratitude. So if you're saying, gosh, I really need a fence, will we do it? Absolutely. Have we done that a few times? Absolutely. But again, I always like to ask, what do the tenants really give feedback on? Is there anything else? Is that a concern? And that just hasn't been a concern on the high majority of our duplexes.
Great, thanks, Jim. And let's see.
Let's take one
Yeah.
to two more rapid and get everyone off by 10 after. I know it's late. I gave the extra guided tour around the office. I'm glad we could do that. And again, I love answering questions. We make ourselves available. The property counselors do, but I want to get you back to your family. So let's do 2 more rapid fire, Allison. We'll call it a night. And if any
You
questions
got
didn't get answered, we'll get those jotted down and reach out to you guys. As long as we have your email address, we'll get in touch with you.
Awesome. Kishore says, thank you. The infill lots to existing neighborhoods make sense. So that's good. And let's see here. I missed these. It says there are some questions in the chat box too, if you'd like to go over there. So let's find those messages in the chat box. Let's see, where is that chat box?
Webinar chat. I do see something about best vehicle, real estate LLC, for
Yeah.
properties in your name. So let's look at that one, Michael. Myself, I buy a property in my name. After I close, I deed it into an LLC with me and my wife as the managing members. It's much better to have multi-members in an LLC than a single member LLC. And then I do put an umbrella policy over my properties, but I don't hold anything in my name. I do qualify in my name to get the best rates though. That's just me. Again, I'm not an accountant or an attorney. I'm just telling you what I've personally done on many, many properties. Do you recommend investors get a master's insurance policy that covers multiple properties as their portfolio grows? I do, Kenzie, but not too early. Not too early. You again, talk with Chris Salome. We love Leland Insurance. They've done hundreds and hundreds of deals. People always go, well, Jim, who do you use? Who does Chris use? Who does your team use? That's who I use for the majority of my properties. That's who his company does a number of the policies as well. He can go over that. There's a time where it's too early, I think, because you have great policies already in place for the general. But umbrella can come in at a certain time. I have activated it. But again, we don't want you to overspend too early. So everyone's an individual situation. So you'll want to talk to him for the best timing on that.
Hey, Jim, let's not miss John. He says an important aspect of whether this is a good investment is the price of the home. How is this set? Great question.
By sales comps for the areas and available rents. So we always want to get you a well-priced, extra well-done home in, like, let's say Ocala, that's priced at the market or just below, near the median value, but with extra upgrades to give it that better rentability and resaleability. So we set that off of sales comps, but then also rental comps. Will we be able to charge the sales price to be able to make a margin for us and also get a cash flow for you based off the rents? So that's how we set prices, looking at not only rental comps, but also sales comps for the area.
Awesome. I think we got them all, Jim, and I apologize if we missed anybody, but I think we got them all. So we
Excellent.
answered them live or we typed the answers. So
Okay. Well, hey, it's always great having, a group like this. Thank you for joining us tonight, guys. Please get in touch with your property counselors. They can get you on a nice track to where we want to go. We want to see you buy back your time, have more time with your family, doing the things you want to do with that passive income, active freedom. And real estate's the way that I was able to do it, and it's the way we want to see you do it as well. So we appreciate you joining us tonight, Allison and Jaden. Thanks for helping control the panels for me, because you're now technologically challenged. I am. That's why I'm in real estate. But thanks for joining us tonight, guys. Come for a visit if you want to see the operation, the properties, the processes, the markets. We love visitors, so come see us, and hopefully we get to talk to you soon. Take care, everybody.
thanks, Jim. Thanks, everybody. Bye.